Welcome back to Financial Reporting Analysis with me, John Bone. In this particular reading, we're going to be looking at the financial reporting mechanics. In other words, the mechanics of producing those accounts and how the accounts and financial statements interrelate with one another. Our first learning outcome here asks us to describe, explain and classify common asset accounts. So we're looking at how assets are classified, and we're also looking at the relationships between the financial statements and how those assets are classified into them. So let's run down our list of what we've got here as assets. Now remember, we defined an asset earlier as everything the company owns and everything the company is owed. So let's start off with cash and cash equivalents. Cash is simply the cash balances that the company holds. In other words, money held in bank accounts. What's a cash equivalent? A cash equivalent is something, and normally an investment, that is almost as good as having cash. Now our definition here tends to be short-term money market instruments. In other words, debt instruments with very short terms to maturity, typically in fact less than 90 days. Accounts receivable, otherwise known as trade receivables. Here's the situation. You sold some goods before year end on credit, but the customer hasn't actually paid you at the balance sheet date. That of course therefore means that customer owes you some money. And that's what we're seeing with accounts receivable. So the amounts that our customers owe us for credit sales that we've made, well, we've yet to collect that cash. Now actually we see the accounts receivable netted against a bad debt provision. One rule for assets is we need to record assets at the amount of the likely future inflow of benefit. Now we know that some of our customers are going to default, they're going to fail to pay us. So we have to estimate that amount, the amount of default, and deduct it from the accounts receivable. So what we're left with is the likely inflow of benefit, in this case the inflow of cash, that we're going to receive from these credit sales. Prepaid expense. What's a prepaid expense? You've paid for a good or service, but you've not yet used it during the year. Now, if we've not yet used the good or service, it won't appear in our income statement. But we've already paid for it. So what we're going to do is we're going to create an asset indicating that we have the right to use this good or service in the future. And when in the future we do use that good or service, we'll eliminate the asset and put the expense in the income statement. A good example of a prepayment that you may well have, maybe you prepay the line rental on your cell phone each month. So you pay it in advance of actually using it. Inventory is our next phrase. Now inventory, again, as Europeans might refer to this as stock. These are the inventories of goods and services that are going to be supplied. So they're made up of three components. First of all, components or raw materials that we're going to use in the production process. Secondly, work in process. Now work in process is where we've started to construct a finished good but have not yet completed it at year end. And the final component of our inventory is going to be finished goods. So these are items that have been completed, manufactured and are awaiting sale. Next one we've got is our property, plant and equipment. PP&E as we often refer to it as. These are our fixed tangible assets. These are long-lived assets that we're going to use in the operations of the company over a number of periods. So it would include things like land and buildings, it would include motor vehicles, it would include plant and machinery. Our next classification is investment property. Now, just be a little bit aware of investment property. You don't see it under US GAAP. So this one only applies to IFRS. And it's used for where you've invested in property purely for its rental potential and its capital appreciation. So it's really like an investment in a property rather than buying a property that you're actually going to occupy and use. Intangibles. These are long-lived assets with no physical form, so you can't touch, feel or hold these intangibles. So what kind of thing will we see in intangibles? Probably the one that everybody's heard of is goodwill that arises when you acquire a subsidiary. So we're going to see goodwill, but other ones might be patents, royalty agreements, etc. Financial assets, investment securities. So these can range from passively held investments, in other words, investments in other companies where we have no control or influence over that company, all the way up to subsidiaries where we have control and influence. So our financial assets. Now it says investments under the equity method next, and we don't really encounter the equity method until level 2. I think all you need to know at level 1 is these are what Americans would call affiliates and what Europeans often refer to as associates. These are companies where we have influence but not outright control. So they don't actually meet the classification criteria of a subsidiary, but they're not a purely passively held investment because we do have influence. We use an accounting method called equity accounting for them. You're not really expected to know what that means until you hit the level 2 syllabus. Deferred tax assets, again. Now, a deferred tax asset, deferred tax is probably one of the trickiest topics that we see in financial statement analysis in the level 1 syllabus. What is a deferred tax asset? I think very broadly, all you need to know is essentially it's going to save us some tax in the long run. So the idea is we've paid more tax now, but we'll pay less tax in the future. Because we're paying less tax in the future, it means lower future outflows of benefit, and therefore it meets the classification of an asset. Again, in a later reading, we'll discuss exactly what deferred tax assets are. Okay, let's turn our attention to common liability accounts. Now, you'll remember our definition of a liability is an amount owed to a third party. And the definition of a third party is not the shareholders of the company. So let's look at accounts payable, otherwise known as trade payables. Now, we talked about accounts receivable or trade receivables being where we've sold goods on credit but not yet received the cash at the balance sheet date. Well, this is the flip side of that, really. This is where we've bought goods or services on credit but not yet paid for them at the balance sheet date. So it's the amounts that we owe to our suppliers at the balance sheet date. Provisions and accrued liabilities. Well, let's take provisions separately. Whenever you hear that phrase provision, it means it's an estimated future expense. Now, the accounting rules of prudence mean as soon as you can foresee an expense, it must be accounted for. In other words, it goes through the income statement. It goes through the income statement, and we need to create a liability in the balance sheet. Okay, so it's a liability indicating that we've got a future expense coming. Accrued liabilities are slightly different. What is an accrual? You've incurred a good or service. You've used a good or service, but you've not yet received an invoice and you've not yet paid for it. Now, a good example of this would be the call charges on your cell phone each year. You know that you've phoned people up, you know you've incurred call charges, but you've not yet received the bill from your supplier. Now, what firms have to do is they have to estimate what these accrued liabilities are likely to be. They put an expense in the income statement and a liability in the balance sheet. Any financial liabilities that we may have. What kind of financial liabilities? It could be short-term debt instruments, long-term debt instruments, leases, for example. Current and deferred tax. Current tax is just the tax that we owe the tax authorities based on this year's profits. We can often refer to that as tax payable, and we'll cover that in a later reading. And we also might see deferred tax liabilities. Now, previously we said a deferred tax asset is where we paid more tax now but will pay less in the future, and paying less means lower outflows of benefit in the future and hence an asset. Well, this has got to be the flip side of it. So with a deferred tax liability, for some reason we paid essentially less tax now but will pay more in the future. And because we're paying more in the future, that means bigger outflows of benefit, and therefore it meets the definition of a liability. Unearned revenue. Now, our examiner seems to really like unearned revenue. This is where the customer has paid us, but we've not yet met the criteria to record a sale. So normally, of course, we increase cash, we could record a sale. But here we're saying, look, the cash has gone up because the customer has paid us, but we can't put a sale in the income statement. But we need to put something somewhere, otherwise the accounts aren't going to balance. So what we do is we create a liability known as unearned revenue. This is indicating, look, we've received cash, but we've not yet met the criteria to record a sale. It sits there as a liability. When the earnings activities are complete and we can record a sale, we'll eliminate the liability and report it in the income statement as revenue. Debt payable, bonds payable. So debt payable might be loans. Again, you've got to be careful as well. They can be current liabilities or they can be long-term liabilities. Often a current liability debt instrument that you should be aware of is something called notes payable that are very short-term loans. But we're also looking at long-term loans, and of course within debt we're looking at bonds as well. Bonds that are issued, essentially corporate IOUs that you've issued, and we'll look at those in more detail a little bit later. Our common equity account. So remember, assets minus liabilities equals stockholders' equity. So let's have a look at what we're likely to see in stockholders' equity. Capital at par value. Now the company gives its stock a par value, a notional value. Let's say we've given our stock a par value of $1. Each share has a notional value of $1. So we've set our par at $1. And that's what you're going to see in the capital at par value line. But it doesn't mean the company has issued the shares at $1. Essentially, you can issue the shares above this. Let's imagine that we've issued each share for $1.50. What that means essentially is if we issue at $1.50, so we issued at $1.50, $1 will go into our common stock at par value, our capital at par value. The remaining 50 cents, the excess over par value, well, we're going to take that to our additional paid in capital. We've already said our additional paid in capital is the excess over par value when the company issues shares. Now again, another key point here, when you're looking at capital at par value and additional paid in capital, you're looking at the amounts when the company first issued the shares. Subsequent changes in market value, if the shares are traded on an exchange, are not reflected in the accounts. So this is the cash the company raises when it issues shares. So they're shown separately, the common stock at par value and the additional paid in capital, the excess over par value when those shares were issued. Again, Europeans might refer to this as the share premium account. Retained earnings, critical one here, the link between the balance sheet and the income statement. Each year we've generated our net income, we then get to pay a dividend if we choose to, and the balance left over gets added to retained earnings. So essentially the change in retained earnings each year are that year's net income minus that year's dividend, essentially, and that therefore goes into retained earnings. Now, the retained earnings is therefore a cumulative amount. It builds year on year. It's all of the profits that the company could have distributed by way of a dividend, but hasn't. And actually, they can be used to pay uncovered dividends going forward. So a retained earnings link, therefore, between the income statement and the balance sheet. What it means, essentially, is anything that affects net income, let's say net income goes up, will affect retained earnings, will give you higher retained earnings. The dividend, of course, higher dividend means lower retained earnings. Other comprehensive income. These are the other comprehensive income items. As we mentioned earlier, certain items, certain gains and losses, if you like, do not have to go through the income statement and instead can be taken directly to stockholders' equity. Now we're going to see a comprehensive income statement later and see those components. At the moment, just be aware, all you need to do is be aware that there are some items that do not go via the income statement and are reported directly in stockholders' equity. Our last line that we've got here is a non-controlling minority interest. Now this only appears in group accounts where you have a subsidiary and you own less than 100% of the equity in that subsidiary. When we produce our consolidated group accounts under acquisition accounting, and that's something we're actually going to be doing at level 2, when we produce group accounts, we bring in 100% of the assets and liabilities of our subsidiaries, even if we don't own 100% of the share capital. The non-controlling minority interest therefore represents the net assets that we've included that actually belonged to minority shareholders rather than our shareholders. Now again, all you need to be aware of at level 1 is this is a component of stockholders' equity. The actual mechanics of how it works will come to light at level 2. Right, let's turn our attention to the income statement. So we've got some common income statement items. So our revenues and our expenses. So our revenues, first of all, our sales. These are going to be our key or our core day-to-day trading operations, the items that we've sold to customers. Now again, remember, we will account for sales when the earnings activity is complete, not necessarily when the customer pays for us, pays for the good or service, known as accruals accounting that we'll discuss a little later. So we're going to show the sales. We're also going to show any gains. Now gains are typically not part of your day-to-day business operations. They could be a gain when you dispose of a long-lived asset. They could be a gain when you retire debt early, etc. So we've got our gains, and we've also got our investment income. Investment income, dividends and interest received. Now, investment income could be an operating item, i.e. part of your core day-to-day business operations, or non-operating. Whether it's operating or non-operating rather depends on the nature of the firm. So if I was a bank, investment income, receiving interest, maybe receiving dividends, would be part of my core business operations, so would be treated as an operating item. If I'm a company like Kaplan Swayze, an education company, receiving interest and dividends is not part of my day-to-day core operations, so it would be treated as a non-operating item. Really, whether something is operating or non-operating depends on the nature of the company that you're looking at. Let's turn our attention to expenses here. We've got our costs of goods sold. These are all of the costs incurred in producing your goods and services, getting them into finished good status. Sales, general admin are any other day-to-day business costs that you incur but are not directly related to producing goods or services. So, for example, the cost of your accounting function maybe. Notice selling costs as well. Cost of goods sold only includes the cost of producing the goods or services. Once they're complete, any additional costs relating to selling those items would go through sales, general and admin. So these are all of the expenses that are not directly related to producing goods and services, but are linked into the daily operations of the company. Now, depreciation or amortization. Actually, you might well find that this is an item that is contained within cost of goods sold or within sales, general admin, rather than shown separately. This is to do with the matching concept as part of accruals, and again, we're going to cover this a little bit later. Now, the idea with our long-lived assets is we're going to store the cost of those in the balance sheet. We're then going to release it over time into the income statement to match against revenues that asset generates. And the process of spreading this cost through numerous income statements is known as depreciation when we're looking at plant, property and equipment, and it's known as amortization when we're looking at intangibles. Now, if we're depreciating an asset that's used in our production process, you'd expect the depreciation to go through cost of goods sold. If we're depreciating an asset that's not used in the production of goods and services, you'd expect the depreciation to be located in sales, general and admin. Interest is our next line. Interest paid in particular. Now, interest paid is a function of our capital structure, our blend of debt and equity, and therefore is shown separately. Typically, the analyst wants to appraise the day-to-day operations of the company and the impact of capital structure separately rather than combined. So we show interest separately on the face of the income statement. We've then got our tax expense. Now again, this will be a provision, an estimate, what we think the company will owe in taxes to the tax authorities based on this year's earnings, essentially. And we might also see losses. Now, these are the flip side of gains that we talked about earlier. So maybe when we dispose of a long-lived asset, or we retire debt early, maybe we'll make a loss. Again, these are items that are not part of our day-to-day business operations, so we're showing them separately in the income statement. Now, our learning outcome changes to explain the accounting equations. Now, these are the if you like, the processes, the mechanics behind the income statement, the balance sheet that tie the financial statements together. Now, you can see the very first one, revenues minus expenses equals net income. Well, of course, we're looking at the income statement with this. Take the revenues, subtract the expenses, you're left with net income. Now again, of course, it's really revenue plus any gains and expenses minus any losses on disposal. And that gives us our net income for the income statement. Now the second equation, of course, is our balance sheet equation, called a balance sheet because assets must always equal liabilities and plus owner's equity. That's why it's called a balance sheet. These two component elements must always equal one another. Now, as we said, assets, everything the company owns, everything the company is owed. Liabilities, the amounts owed to third parties, and of course owner's equity, amounts owed to the shareholders. And earlier we said that's a residual, what's left over. And we can see that more clearly when we look at the next equation that says owner's equity equals assets minus liabilities. Now note, all we've done really here is we've subtracted liabilities from both sides of our second equation. So there's our second equation. Deduct liabilities from both sides, and you're left with assets minus liabilities equals owner's equity. You'll often hear assets minus liabilities being referred to as the company's net assets. Sometimes, as particularly a US phrase, you might hear it referred to as the company's net worth. Okay, so net assets probably more likely to be the phrase that they give it in the exam, but just be aware, if you do hear net worth, means the same thing. So assets minus liabilities equals our stockholders' equity. Now, owner's equity, we then say, is contributed capital plus retained earnings. Again, simplifying a little bit, contributed capital plus other comprehensive income items plus retained earnings. So we've dropped the other comprehensive income items just for simplicity's purpose. Now, the contributed capital is the common stock at par, and it's also the additional paid in capital. The retained earnings, remember, that very important link between the balance sheet and the income statement. Now, following on from that, you can see how our retained earnings work. So we've got our beginning retained earnings, which of course would appear in last year's balance sheet. And we've got ending retained earnings, which are appearing in this year's balance sheet. And all we're really doing is reconciling between them. Notice how our retained earnings are changing. If we've got net income from the income statement, that goes into our retained earnings. So if you're profitable, that's going to increase retained earnings. If you're loss making for the year, that's going to reduce retained earnings. And we've also got the dividend. This is the dividend that the company has proposed during the year. So notice, essentially, the change in retained earnings each year is our net income minus the dividend. You take that year's profit, you decide what you want to distribute to the shareholders. Anything that isn't distributed will increase our retained earnings. So it represents the reinvestment in the company during the period. Also, I should point out here, this is the only place you will see dividends that have been proposed. You don't see them in the income statement. It ends up at net income, and that's the end of the income statement. So you'll see the dividends essentially within stockholders' equity, in particular that reconciliation of opening and closing stockholders' equity that we talked about earlier. Now, our next learning outcome says, describe the process of recording business transactions. So let's say we're going to pay a bill. Let's say we're going to pay a supplier $100 for goods received on credit. Now, if we pay out cash, our cash is going to go down. So let's say our cash goes down by $100. So down's gone an asset. Now, if assets suddenly drop by $100, our equation is no longer going to balance. Equity will no longer equal assets minus liabilities. So either equity is going to have to be reduced or liabilities are going to be reduced. Now, because we're paying a customer, we're paying a supplier, our trade payables, we're extinguishing a liability here. And that liability will drop by $100 as well. So our trade payables goes down. Notice, therefore, in this situation, when you pay a creditor, asset goes down by the cash paid, liability drops. As we've extinguished that liability, equity remains unchanged in this situation. Let's have a look at issuing a bond and try and understand the mechanics there. So essentially we're borrowing money. Let's say we've issued a bond for $1 million. Okay, so our bond is going to have a value of $1 million. Now when we issue that, of course, our cash is going to go up. So up goes the cash by $1 million. Up goes assets. Now again, equity or liabilities are going to have to increase, or it's simply not going to balance. As it happens, of course, it's going to be the liabilities that increase by $1 million. So up goes our liabilities by $1 million, indicating that, of course, we've borrowed this money and ultimately we owe it back. So up goes liabilities by $1 million, assets up by $1 million, liabilities up by $1 million, equity therefore remains unchanged. Let's make a credit sale. So let's set up an example for this. Let's say we sell inventory that had cost $80 and we sell it on credit for $120. So let's say our inventory had cost $80 and we sold it for, on credit, $120. So let's have a look at this. Now, when we sell the inventory, our inventory line, which is a balance sheet current asset, is going to drop. So down goes our asset by $80. But we've sold these goods on credit. So the customer now owes us $120. So accounts receivable or trade receivables is going to increase by $120. So notice, therefore, we've got a net increase in our asset of $40. Now, equity, it says retained earnings increases by the difference. So what we're saying is, look, when we look at these two over here, net impact is an increase in assets of $40. So if assets gone up by $40, we're actually going to increase retained earnings, i.e. stockholders' equity, by $40. So that's going to go up by $40. But let's look why that's the case. And to see why that's the case, we're going to have to examine the income statement. First of all, let's just do it. Let's think about it. So our revenue is going to increase by $120, the amount we sold the goods for. So essentially, we've got a sale for $120. How much did it cost? Well, the inventory that we sold cost $80. So our costs of goods sold, $80, giving us a profit of $40. So what we're saying is our net income in the income statement would have increased by $40. And remember, if net income goes up by $40, retained earnings goes up by $40, again, assuming that we don't suddenly increase the size of the dividend payment. Okay, so anything that hits the income statement by default will affect the balance sheet via this line, via our retained earnings line. It's the link between the income statement and the balance sheet, meaning anything that affects the income statement must have an effect on the balance sheet. It will affect retained earnings. So overall, our equity has gone up by $40 and our asset has gone up by $40. Let's buy some materials on credit. So we bought some materials from a supplier, but we've not yet paid them. We bought them on credit. Let's make up again a number. Let's say $2,000 worth of inventory we buy. So first of all, we bought some inventory for $2,000. Up goes our inventory, and of course, that is an asset. So up goes assets. But we need to record the fact that we owe our supplier. So we're going to create a liability, accounts payable or trade payables. And of course, that's also going to be $2,000. So again, up goes the asset, up goes the liability, equity remains unchanged. Issuing some stock, so issuing some equity. Again, if you're European, we tend to refer to it as shares. US tends to refer it as stock issues. It just means the equity of the company. Okay, so let's say we issued, let's say 1,000 shares at $2.50 when par value of those shares was $1. Okay, now first of all, obviously the total cash raised is $2,500. So up goes cash in the balance sheet by $2,500. No problem there. Up goes our cash, up goes our assets. Liabilities. Well, again, liabilities are amounts owed to third parties, and the shareholders are not a third party, so that remains unchanged. So it's going to be an impact on our equity. So our common stock is going to increase. And actually, remember, we need to deal with the split. We have the common stock at par. And that's going to be $1 shares, 1,000 shares. So that's going to be recorded at 1,000. And the other entry, of course, is the additional paid-in capital, sometimes referred to as APIC. Remember, that's what Europeans would refer to often as a share premium. Well, the excess will go to that. So the remaining 1,500 goes into additional paid-in capital. Overall though, equity has risen by the combined amount, 2,500. So again, it all still balances. So notice always, 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 we're making sure that equity equals assets minus liabilities. This time we've incurred an expense. Okay, so maybe we've got a rental expense. We know we've occupied our premises for 12 months. We've received an invoice for the rent of our premises. Okay, so notice we've received an invoice here. This is essentially not a cash expense. This is where we've actually got a liability. So we've received an invoice from our landlord. Let's say it's $10,000. So we're going to create a liability because we need to pay that bill at some point of $10,000. Up goes our liability. Assets, of course, remain unchanged. It's not an asset. Other side of that is it's actually going to affect the income statement, because it's now that $10,000 is going to go through our income statement representing the rental expense during the year. So it's going to affect the income statement. In the income statement, we're going to have an expense of $10,000. And because we've got an expense of $10,000, that's going to mean our net income is lower by $10,000. And if our net income is lower by $10,000, then our equity is going to be lower by $10,000. So equity goes down by 10,000. So notice liabilities have gone up by 10,000, giving you a smaller net asset figure. And remember this, assets minus liabilities, net assets. So our net assets have decreased by 10,000 because of the increase in the liability, and equity has fallen by 10,000 due to the decrease in retained earnings. Pay a liability. So this is paying a liability. Let's take that rent example that we had as transaction number 6. So that was when we received the invoice from our landlord. Now we're actually coming to pay the bill. So our cash goes down by 10,000. So down goes cash, which of course is an asset. So our assets are going to fall by 10,000. But we no longer owe our landlord that 10,000. So we're going to eliminate the liability. So the liability falls by 10,000. So they're both down by 10,000, meaning equity remains unchanged. Declare a dividend. Okay, so this is when the company declares a dividend. That's not the same as paying the dividend. Typically the company will declare a dividend at year end, but it won't be paid until after the year end. Often dividends will need to be approved in the AGM by the shareholders before they can be distributed. So here we're just declaring a dividend. Okay, now let's say we declare a dividend of $15,000. So we've declared a dividend of $15,000. So we're going to create a liability for $15,000, indicating we owe our shareholders this money, $15,000. Assets unaffected. Okay, we haven't yet paid them. When we pay the cash out of $15,000, then assets is going to fall. Here we've only declared. The other element though is our retained earnings decreases. Remember, we had essentially our beginning retained earnings from last year. We added on that year's net income. We then subtract this year's dividend to get essentially the closing retained earnings. Now, essentially what that means is if we suddenly propose a dividend of 15,000, this is now 15,000. And of course, that means our closing retained earnings drops by 15,000. So our retained earnings is going to decrease by 15,000 to keep it all balancing. Now finally we've got to the point where we actually pay that dividend, the cash goes out. So in this situation we're going to pay that cash out, down goes the cash, 15,000. And of course we eliminate the liability. And therefore equity remains unchanged. It's noticeable therefore, it's not when the dividend that is paid that affects equity, it's when it's actually proposed. Just like it wasn't when customers paid us that affected equity, it's when the sale was made. And it wasn't when when we paid suppliers that affected equity, it was when we made the purchase. So very interesting, and this is all created from the accruals mechanism that we're going to talk about a little later. Our next LOS asks us to describe the need for accruals and valuation adjustments. Now the idea behind accruals is we're going to record revenue in the period in which it's earned, rather than when we collect the cash from the customer. With expenses, they're going to be reported when they're incurred, rather than when we pay any cash. The accrual objective is to allocate revenue expenses into the appropriate periods. Let's have a little look at a few of these adjustments here. First one, under assets, we have bad/doubtful debts. Now the idea is our accounts receivable represent the amounts that we're due from our customers at the balance sheet date. However, we know some of those amounts will be uncollectible, i.e. customers will default. Therefore, we need to reduce the asset by the amount we think we won't be able to collect. So we net the doubtful debt provision against the accounts receivable. That's so in the balance sheet, the asset only represents the cash that we'll actually collect. In other words, the benefits, the inflows of benefits that we're likely to receive. The other side would be an expense in the income statement, reducing net income. Prepaid expenses. We've incurred a cost, we've paid an expense, but we've not yet used the good or service. Now, because we haven't used the good or service, we shouldn't see an expense in the income statement. So instead, we record it as an asset. Then, when we actually use the good or service, we're going to eliminate the asset and report it as an expense in the income statement. Unbilled or accrued revenue. Now, unbilled or accrued revenue, we've met the criteria to record a sale. So a sale needs to go into our income statement. But we've yet to bill or invoice the customer. So it's not in any of our accounting entries. So what we need to do is record the sale, and we're going to record an asset as the balance to that in the balance sheet. Impairments and write-downs. Now impairments are to do with our long-lived assets, and write-downs are to do with inventory. Now the basic rule of our long-lived assets is they need to be reported at the lower of carrying value and fair value. Now carrying value is just a name that we give to balance sheet value. So if the asset's fair value has declined below the balance sheet value, we potentially have an impairment of our long-lived assets, PP&E, intangibles, etc. And what we have to do is reduce the balance sheet carrying value down to the fair value. So we reduce the balance sheet amount, and the other side appears as an expense in our income statement. Write-downs are very similar, but for inventory. The idea with our inventory is it needs to be carried at the lower of cost and market value. Now, if market value has declined below cost, we've got to write down, reduce the balance sheet asset, and report the decline in the balance sheet asset as an expense in the income statement. Some of our balance sheet assets can be carried at fair value rather than historic costs. So we've got some mark-to-market investments are available for sale in our trading securities. Now again, I don't want you to worry too much about what these are right now, but in a later reading we're going to talk about exactly how these are accounted for. Essentially, these are passively held investments that we're going to carry in our balance sheet at fair value rather than the original purchase price. Liabilities, accrued expenses. Again, we've touched on this already. The idea is we've actually used a good or service, but we've not yet been billed for it. Because we've used the good or service, the accruals concept says that expense must be in the income statement. So we put the expense in the income statement and we create a liability in our balance sheet known as an accrual. Unearned deferred revenue. In this situation, the customer has paid you, but you've not yet met the criteria for recording a sale. So our cash has gone up, but we can't report a sale. Something else needs to go up, otherwise the balance sheet isn't going to balance. And what we're going to do is create a liability for unearned or deferred revenue. Now, when we meet the earnings criteria to record a sale, we'll eliminate that liability and record it as a sale in our income statement. And the other one we have here is provisions. Provisions, remember, are an estimated future expense. As soon as you can foresee an expense, the accounting standards require us to record the expense in the income statement and create a liability in the balance sheet. Our next LOS asks us to describe the relationships between financial statements. So here we are with four of our key financial statements: the income statement, the statement of changes in owner's equity, the cash flow statement, and the balance sheet. Now let's have a look between the income statement and the changes in owner's equity. Now, the key point when we're looking at the changes in owner's equity is to think about our retained earnings. And remember, the change in retained earnings each year is equal to that year's net income minus that year's dividend proposed. So therefore, if net income goes up in the income statement, net income goes up in our balance sheet, in our retained earnings calculation, and we get a greater retained earnings. So anything that hits the income statement by default will affect owner's equity. Now, of course, owner's equity is also reflected in the balance sheet. Now remember, the statement of changes in owner's equity is just a reconciliation. It takes last year's stockholders' equity and reconciles it with this year's stockholders' equity. And of course, this year's stockholders' equity is found in our balance sheet. The other element, of course, we've got here is the cash flow statement. Now, what the cash flow statement does is it takes last year's balance sheet cash figure, this year's balance sheet cash flow figure, and explains why it's changed. And of course, it breaks it into our three classifications: our cash flow from operations, our cash flow from investing, and our cash flow from financing. Now, link between the income statement and the cash flow statement, well, what we're going to do is we're going to take our net income and we're going to subtract any non-cash items, and we're going to be doing this in a later reading, and that will take us to our cash flow from operations. So there's certainly a linkage between the income statement and the cash flow from operations. Of course, the link between the cash flow statement and the balance sheet is when we sum these amounts. That, of course, is the balance sheet change in cash. The difference between last year's balance sheet cash figure and this year's balance sheet cash figure. Now, our next LOS asks us to describe the flow in an accounting system. Now, the first thing we have here are our journal entries. Our journal entries are all of the transactions that the company enters into, listed as debits and credits. So it's essentially a book of debits and credits. Now, these days it's a computerized system, but if you think to Christmas Carol and Bob Scratchit or whatever he was called, there he was scribing with his big quill in essentially the journal entry book. So all it's going to do is record each transaction in date order in terms of debits and credits. Now, at the end of a period, let's say a year, what we're going to do is take all of those debits and credits from the journal entries and put them into T accounts. A T account is going to summarize all of the journal entries and condense all of that data into one figure that's either going to go into our income statement or balance sheet. From the ledger T accounts, we take what's called a trial balance. These are the figures. Remember, the T account is trying to summarize all of the information from the journal entries into one figure. The trial balance is then just a big list of debits and credits, and it's called a trial balance because essentially the sum total of the debits should equal the sum total of the credits. It's a one way that we can ensure that the double entry bookkeeping process is actually correct. Now, from the trial balance, what we're then going to do is post journal adjustments. These are the accruals and valuation adjustments that we've just discussed. They're not included in the original book of journal entries. That just includes each transaction as it's incurred by the company. So at year end, we're going to need to make a series of accruals and valuation adjustments, and these are these journal adjustments we're looking at here. We then apply those journal adjustments to our original trial balance to get a new trial balance, which is typically called the adjusted trial balance. Sometimes you hear it referred to as being an extended trial balance. Now, this is essentially all of those ending figures after valuation and accruals adjustments. Again, it's a big list of debits and credits, and it allows us to ensure that our double entry is still working. In other words, the total of the debits must equal the total of the credits. From this adjusted trial balance, we take each of those items and we produce our financial statements. So in other words, we're going to produce the income statement and the balance sheet, particularly from our adjusted trial balance. Now, our next LOS says, describe the use of results. So what we're really doing is saying, well, what are we going to do here for security analysis? So we know our financial statements contain estimates, judgments, And of course, those are our accruals and valuation adjustments that we put through at year end. Key point, of course, is we need to make sure that those are consistent year on year, and of course consistent maybe between competitors. So we might want to do some benchmark reviewing of the accruals and estimates that have been used for our company. Analysts must review MDA and footnotes. Now, of course, one big reason why we should review the management discussion and analysis is if there has been changes to accounting policies, the reason for those changes should be noted here. Footnote, of course, disclosure, absolutely vital as well. With the footnote disclosure, again, you'll see the accounting principles and policies that the company has used being described and any significant estimates as well. Again, very important that the analyst reviews those accounting policies and estimates for reasonableness. Misrepresentations. Now, we said that the trial balance is one way of ensuring the double entry bookkeeping is working. In other words, the total of debits equals a total of credits. Well, that's true. It does ensure the double entry process has worked, but it doesn't ensure that the accounts are still correct. All it does is it means for every debit there's been a credit. It doesn't mean that we've credited the right account. So for example, I've received some cash and made a sale. I should have theoretically gone debit cash credit sale, but maybe I've gone debit cash and credit some other balance other than sales. The debits and credits would still add up, but essentially I've not credited the right item in the income statement. So again, notice it says make appropriate adjustments for analysis. This is really touching on a point that there may be some items that we don't believe are correctly reflected in the financial statements. Now, the big one that we have in the CFA Level 1 is the treatment of operating leases. You're leasing an asset, it's treated as an operating lease. Even though you've got the commitment to make payments under that lease, there's no recognition of an asset and there's no recognition of a liability. Now, as an analyst, we might disagree with this treatment and think there should be an asset and there should be a liability, and therefore we might make adjustments.